Hey, have you ever looked at a price chart, plotted out your support lines perfectly, placed a seemingly logical stop loss, and then watched in absolute frustration as the market drops just enough to take you out before rocketing right back in your predicted direction? Yeah, you're definitely not alone. It's the worst feeling, right? Well, welcome to This Explainer. Today, we're going to decode the hidden mechanics of institutional trading. We're going to completely transform how you view the market's ecosystem, literally looking at the charts differently from here on out. Let's get into it. So here's a quick look at our agenda. We'll start with the market's hidden bloodstream, locate exactly where liquidity hides, and compare sweeps versus grabs. Then, we'll spot these sweeps in real time on the charts, and finally, learn to trade them with solid confirmation. All right, Section 1, the market's hidden bloodstream. From now on, I don't want you to just see price action. I want you to see where the orders actually live on the chart. You see, in the institutional trading world, specifically when we're talking about smart money concepts, liquidity isn't just a measure of volume. It represents a literal concentration of resting orders. We're talking specifically about stop losses and pending buy or sell orders. These resting orders, they're literally the prey that the big players actively hunt down so they can fill their own massive positions without causing insane slippage. As this quote hits the nail on the head, liquidity is the market's bloodstream. Think of it like fuel. I mean, an institution can't just press buy on a $100 million position. If they actually did that, the price would gap violently away from them. Instead, they need a massive pool of opposing sellers to take the other side of their trade. Without consuming the resting orders of retail traders as this vital fuel, large institutions simply cannot move the market. It's literally impossible. Okay, moving on to Section 2. Where exactly does all this liquidity hide? I want you to be totally honest with yourself for a second and really think about your own trading habits. When you place a trade, where do you instinctively hide your stop loss? Think about that point on the chart. Odds are you're putting it exactly where practically every other retail trader is putting theirs. Retail traders incredibly predictably cluster their orders at specific structural points. The most common magnets, swing highs and swing lows. Then you've got equal highs and equal lows, your classic double tops and double bottoms. While retail views these points as undeniable, rock-solid support and resistance, institutions view them as a guaranteed cluster of stops. We also see liquidity resting outside clean, dynamic trend lines and channels, at psychological round numbers, and at previous session highs. And finally, there's external range liquidity sitting outside the dealing range versus internal range liquidity, like fair value gaps inside the range. Basically, everyday traders mistakenly turn what they believe to be safe havens into highly targeted liquidity pools. It's like a giant bullseye. Section 3. Liquidity sweeps versus liquidity grabs. Now, people swap these terms around a lot, but a grab and a sweep actually have entirely different scopes, speeds, and intents. Let's break it down. A liquidity grab is a pinpoint surgical tag of a very specific level. It's usually a super fast single candle wick that immediately closes back inside the prior range. Its main intent? Just harvesting some nearby stops for quick mean reversion. But a liquidity sweep? That is a broad, aggressive movement. It spans several candles, clears out multiple levels, and leaves a massive displacement candle and a fair value gap right in its wake. The intent of a sweep is to absorb a truly massive pool of liquidity to fuel a major market reversal. All right, Section 4. Let's talk about spotting these sweeps in real time. So, how do you spot a sweep instead of getting faked out by a standard breakout? You gotta watch the charts for 3 specific footprints. First up, candlestick rejection. You're looking for a long wick stabbing violently right into the liquidity pool, but crucially, the body closes back inside the previous range. Second, keep an eye out for volume spikes. You want to see a sharp volume increase confirming a massive cluster of retail stop orders just got absorbed. And third is displacement. That's a large, full-bodied candle moving aggressively away from the sweep. When you see that, that is institutional intent showing its hand clear as day. And finally, Section 5, trading these sweeps with confirmation. Look, instead of panicking the second a key level breaks, you need to follow 3 disciplined steps. Step 1, wait for a market structure shift, which you'll sometimes hear called a change of character. Basically, let the price break a recent countertrend swing with strong displacement to confirm it's a true reversal. Step 2 is choosing your actual entry type. And step 3 is setting unshakable professional risk parameters. Let's dive into those last 2 a bit more. When it comes down to actually entering the trade, you're faced with a bit of a strategic dilemma. You can take a conservative entry, where you patiently wait for the price to retrace back into the fair value gap created by the sweep. It's a much higher probability setup, but you totally risk missing the move entirely if the market just takes off. On the flip side, an aggressive entry means entering immediately at the close of that big displacement candle confirming the sweep. It guarantees you get in the market, but it definitely requires you to use a wider stop loss. And speaking of stop losses, the rule here is absolutely non-negotiable. Your stop loss must be placed entirely beyond the extreme point of the sweep wick. Why? Because if the price actually returns there, the institution wasn't actually reversing the market, and your setup is completely invalidated. Period. Now, for your take profit, you simply look across the range and target the very next liquidity pool or unfilled fair value gap on the opposite side. That's exactly where the institutions are going to be looking to offload their positions. As we wrap up this explainer, I really want you to take a hard look at the charts you pull up tomorrow. Remember, the market isn't just random chaos. It's a highly engineered machine, perfectly designed to seek out and consume liquidity. So the next time you go to place your stop loss right at that perfectly obvious double bottom, ask yourself, are you actually protecting your trade, or are you just providing the necessary bloodstream for the next institutional sweep? Keep your eyes open, wait for that displacement, and start trading with the big money, not against it. Catch you next time.